So you want to own a business as a developer. You quit the job, you form the company, you write the code, and one day the recurring revenue pays for the life you actually wanted. That's the pitch. But here's the part nobody tells you before you sign anything. The cheapest business you will ever start is also the one most likely to quietly eat a year of your life and hand you nothing back. By the end of this, you'll know what this business actually costs, where the margin disappears to, and which version of it is designed to fail before you've written a single line of code. Start with the number that's supposed to comfort you. Forming an LLC in the United States runs anywhere from $35 in a state like Montana to $500 in Massachusetts. National average, about $130. Add a registered agent, an operating agreement, maybe a domain and some software subscriptions, and you're looking at $700 to $1,000 to have a fully legal company. If you're filing in California, add an $800 franchise tax, due every single year whether you make $1 or $1 million. Compare that to a restaurant, where you need somewhere between $250,000 and $500,000 before a customer ever walks through the door. Compare it to a coffee shop, where the espresso machine alone can run $15,000. That same $250,000, sitting in an index fund instead, would have compounded quietly for a decade while the restaurant owner was still paying off the lease. Your number, next to theirs, looks like a rounding error. And a rounding error is exactly what should make you suspicious. Because the LLC was never the real cost. The real cost is the one that never shows up on a bank statement, and it's the one the industry works very hard not to mention. It's your time. Price it honestly. A senior developer making $180,000 a year is worth roughly $90 an hour on the open market. Put in 15 hours a weeknights and weekends for a year building a product before you have a single paying customer, and you've just spent $65,000 of your own labor. It never hit a credit card, so your brain never registered it as spending. Add the self-employment tax you'll owe the moment you do start earning, 15.3%, on top of ordinary income tax, because as your own employer you now pay both halves of Social Security and Medicare that a company used to split with you. Add client concentration. The day one client is 60% of your revenue. You've effectively signed an 80% lease on a business you don't control. And add the one nobody budgets for at all. The unbilled hours. Proposals, scoping calls, revisions you agreed to because saying no felt confrontational. What percentage of a solo developer's working week actually turns into an invoice? Somewhere around 50 to 60%. Which means the rate you quote a client is, in practice, cut nearly in half before it reaches your account. Now we get to the question that actually matters. Where does the money come from? A cafe sells a latte for $5 that costs about 85 cents to make. An 83% margin the entire coffee industry brags about. You can bill $10,000 for a project that costs you your time and maybe $100 in API credits. A margin north of 95%, on essentially every job. On paper, there is almost no business on earth with better unit economics than a developer selling outcomes to companies. But that 95% is a starting point, not a paycheck, and here's the mechanism most developers never learn. The moment you price by the hour instead of the outcome, you've rebuilt your old job, minus the health insurance, with a ceiling you set yourself. There's a real legal lever here that changes this math, and almost nobody uses it early enough. A single-member LLC is taxed as a sole proprietorship by default. Every dollar of profit flows straight through to you and gets hit with that 15.3% self-employment tax. Elect S-corporation status once your profit clears roughly $80,000 to $100,000. Pay yourself a reasonable salary, and take the rest as a distribution, and that distribution isn't subject to self-employment tax at all. On $100,000 of profit, that election alone is commonly worth $5,000 to $8,000 a year back in your pocket. Not a deduction, a structural rerouting of how the money is classified. And this is where the real flywheel starts. One positioned client relationship becomes a case study. The case study becomes a referral. The referral becomes a retainer instead of a one-off invoice. The retainer becomes predictable cash flow, and predictable cash flow is the only thing that lets you say no to bad fit work, which is what lets you raise your price, which is what funds the first hire, which is what turns a freelancer into an agency with an exit. The object is rarely the investment. The mechanism is. Every developer chasing the SaaS that changes everything is looking straight past the compounding machine sitting one email away. If you want to see exactly how that flywheel compounds when someone runs it for a decade instead of a year, stick around, because that story is coming up next. Because here's what nobody tells you about owning this business. You're not buying a laptop and a domain. You're buying a stack. Layer 1 is optionality, the ability to walk from a bad client without walking from your income. Layer 2 is compounding proof, every finished project becoming collateral for the next sale. Layer 3 is pricing power, because outcome-based pricing scales with the client's budget, not your hours. Layer 4 is distribution, the referral network that eventually replaces cold outreach entirely. Layer 5, the one almost nobody names, is optional employment. You're the only business owner on the planet who can shut the company down for 6 months and reopen it with 0 notice period. And the layer the buyer actually cares about most, whether they admit it or not, is control. Not money. Control over whose problems they solve and on what terms. That control is also the entire architecture of the businesses that survive. Physically, the winners strip the business down to almost nothing. No office, no inventory, sometimes no employees at all. Psychologically, they've made peace with the fact that selling is the job, not a chore that happens after the real work. And on the data layer, the ones who make it are tracking one number obsessively. Pipeline built during the weeks they were too busy delivering to notice it emptying. Every structural choice a surviving developer owner makes exists to protect one of 3 things: their time, their pricing power, or their pipeline. Take Pieter Levels. Dutch, self-taught, no computer science degree. Working as a copywriter before he ever shipped a product for money. In 2014 he ran a public experiment. Build 12 startups in 12 months. Almost all 12 died. He's since put the real number of failed projects at over 60. What survived was Nomad List, a spreadsheet of cities for remote workers that he charged a small fee to access. It took him 4 full years to get that project, plus a job board called Remote OK, to a combined $1 million in annual revenue. Today, running both plus an AI photo tool called Photo AI, solo, with 0 employees, on a stack of plain PHP and SQLite, he pulls in roughly $3 million a year. I don't guess what people want, he said of the approach. I ship and I watch what happens within 48 hours. 60 failures. 1 person. 0 funding rounds. Now put that next to the far more common version of this story, which never gets a headline because there's no dramatic ending, just a slow one. A solo developer, the kind counted in the tens of thousands every year, spends 8 months building a SaaS product nights and weekends. No clients consulted first. Launch day arrives. 40 people sign up, 3 of them pay, and by month 6 the subscription revenue doesn't cover the hosting bill, let alone the 8 months of $90 an hour time that went into it. There's no dramatic collapse. Just a GitHub repo that stops getting commits, and a founder quietly job hunting again. This is a composite, not one person, because it's the modal outcome, not the outlier, and that's precisely why it doesn't make the news the way Levels does. So which one would you bet on if you were starting today? The person who shipped 60 ugly, embarrassing failures in public before one of them worked, or the person who spent a year perfecting one product nobody had asked for? That's the actual question this entire industry runs on. But this business does have one real, structural weakness. It's not the code. In 2 years of watching developers try to escape employment, the failure pattern is almost never technical. It's sequencing. They form the company, buy the domain, build the beautiful landing page, and only then go looking for a human being willing to pay. That order is backwards, and it's backwards because building feels like progress while selling feels like rejection. So developers default to the version of the work that doesn't require talking to anyone. The second failure mode is concentration. 60+% of revenue sitting with one client is the developer business equivalent of signing a lease at 80% of your expected income. And just like a physical lease, you don't feel the danger until the client leaves, usually in the exact month your pipeline happens to be empty, because pipeline only gets built during the weeks you weren't fully booked. And if what you're actually chasing is privacy, flexibility, or just not answering to a manager, it's worth asking honestly whether owning a company is even the right tool for that, or whether a well-negotiated contract role gets you there with none of the tax filings. Let's do the actual math. Scenario 1. The Upwork path. You list yourself at $85 an hour, compete globally on price, and realistically bill 20 to 25 hours a week once sales time is subtracted. That lands you somewhere between $85,000 and $110,000 a year, before self-employment tax, before your own health insurance, before a single day of paid vacation. Net take-home, often lower than the salary you left. Scenario 2. The positioned path. You pick a narrow local market, productize 2 offers, a $5,000 to $15,000 implementation project and a $2,000 to $5,000 monthly retainer, and run 3 retainers plus 1 project a month. That's $15,000 to $25,000 monthly, at a gross margin north of 90%, with total operating costs still fitting on 1 credit card statement. Same skill set. Same laptop. 1 path caps at your hourly rate forever. The other compounds. And that same starting capital, left in an index fund instead of spent on either path, would have grown quietly with 0 client concentration risk and 0 unbilled hours, which is the version of this story most people never bother running the numbers on. Eventually, every version of this business needs an exit, and it rarely looks like a dramatic acquisition. Most developer owners exit by selling the client book and the systems to another operator, folding the agency into a productized tool that can run without them, or simply letting the retainers wind down while they pivot the proven service into software. What the wealthy developer owner is actually buying, underneath all of it, was never the code. It was control over their own calendar and the option to walk away from any single client without walking away from their income. If you're the kind of person who wants to see exactly how that transition from service to software actually gets built, step by step, that's the next video, and it's worth being here when it lands. Here's the honest version of the paradox. The cafe owner risked $250,000 on a business with brutal, unforgiving tolerances. You risk almost nothing financially. Your tolerances are entirely behavioral. Pieter Levels turned 60 embarrassing failures into $3 million a year, alone, with a laptop and no funding. Most developers never run that experiment even once. The code was never the hard part. The conversation always was.